Hi everyone, I hope you guys are good. So this is the last video. This is the last video of the pattern recognition series. This is part 5 of 5, which is Bitcoin. Before I start, I would like to. My mentor used to do this exercise. If you maybe can take a chance and pause the video and just see if you can find the analysis right here. If you can be able to find the 711 pattern around here, if you can be able to find it, just pause the video and do that exercise a bit to train if you can be able to find what I'd be looking for as the 711 model. So just pause the video, look for it, and if you don't find it, it's okay. You can just see how I've made my analysis. So now I'm gonna put my imitations. So sorry, these are the imitations that I did for the Bitcoin. So remember, from the beginning when we start from the opening range, which at this point today we're trading the 7 a.m. model. Previous videos we were using the 1 a.m. model, 1 to 5 a.m. So now we're going to be trading from 1 to 11 a.m., which 11 a.m. is around here. Yeah, here's 11 here. So now we're trading the 7 11 model. This is 11, this is 7. So now first thing that you need to do is to mark out the opening range of New York AM session, which is from 6 a.m. to 6:30. This 30 minutes interval, it gives you the measurement of the day. Like if you can just measure this from this low here up to this high, uh, here's the high, up to this high, you'll find the second standard deviation, which is here. Let me just move my deviation, which is here. As you can see, the price traded to it and reverse when it gets to the second standard deviation. So keep notes of this 630, 6 to 630 if you're trading the 7A model, and 00 GMT to 0030 if you're trading the London session. So just keep those times in your diaries, so you can be able to, once the price get to they've done this consolidation here, you that's when you can be able to start to measure your deviations. So now we have the buy side here, and right here in the orange is the 1 hour fair value gap. It's an inversion fair value gap here. If you can just go to your chart, you can be able to see this fair value gap, because I'm using the most recent price, the price that's trading now. So you can just go to your chart and go to your 1 hour Bitcoin. You're gonna see the inversion fair value gap I'm talking about. So for now, can I just remove this? I don't like a lot of imitations in my chart, but you did note of the 1 hour fair value gap, that one that I've marked. So now we've found the second standard deviation with this range here, and in the sell side also, we measure from this high to this low, here, and then we have our second standard deviation also here. So as you can see, the price started to get to this deviation here. Let me remove my fib. The price traded to this deviation here when we measured, and then it went to the buy side of the deviation. Then at 7 a.m., this is a 7 a.m. candle. You've marked the 7 a.m. The price created a displacement lower. It created this high and this low, this high, and all of these lows down here. So this becomes a relative equal highs and relative equal lows. So at 7:30, this is where you mark your true open. This is the opening of the 7:30 of the New York session. So price traded higher and take out the buy side, take out the 7 a.m. high, you take out the buy side liquidity, which are these highs here, So you need to be careful with your liquidity. Know your liquidity, know where the price is likely to draw to, so you can be able to find the free, good, clean setups. So the price went to the buy side and it took out this liquidity here. So once the price gets to the opening range that I've marked here, the second standard deviation, and if you remember the fair value gap here, this was the 50% range. It was the consequence encouragement of the fair value gap. So this is where you've taken your first entry here. This is where you took an entry here. But if you do miss out this entry, the price created a displacement low and it traded lower to this low and retraced back to this fair value gap here. As you can see, we have this fair value gap where the price traded to it. So once the price has done this, this gives a good signature that the price is going to be going lower. It's going to be going lower to the lows here. I'm going to explain once I get to it. So this was going to be your second entry here. if you miss this entry and you miss this entry also, you're gonna have to wait till the price get to the New York True Open. So here's the New York True Open. You know, I always use the True Open as entries. So now we have the high, low, and this high didn't take out this one. So this is a mitigation block. That's where the price retraced to. If I can just show you my, let me show you my execution. Yeah. So if you miss this trade, you miss this entry, you miss this entry. There's always a true open that you can trade using. Because I was not in my chart when the price was doing. So I was looking for this to happen, but I wasn't in my chart to sorry, to check all this movement here. So once the price did this, I waited for the true open because I just wanted to prove a point when it comes to true open. So I took a sell here above the true open. I took a sell on two contracts, and I've targeted this fair value gap here, and I've measured this high here, this high to this low here. Why did I measure this high and low? Because this range here is responsible for taking out this buy side liquidity here. As I showed you, you have this buy side here. So as it took out the buy side, I'm going to use this range to measure the deviation. So here's the second standard deviation here as I've marked it here. So that was my initial target for this trade. Um, the price started to consolidate here, took out the relative lows, consolidated back to the New York True Open, and then it traded lower to this 1 minute fair value gap that's below the midnight open. So remember, I have the midnight open here. Here's the midnight open candle. I'm going to show you also this fair value gap, how I found it. Where's this midnight? So here's the midnight 00 GMT. Midnight opening, here's the candle here, and below the midnight, as you can see, we have a fair value gap here below this. So this is a fair value gap. I'm using this one because this one is the most closest to the midnight opening. So that's the fair value gap that I use to find the target for this particular session. So the price traded to this, then I took one contract out. When I saw the price creating these highs here, creating this respecting this fair value gap here, I took out the second entry because I took two entries there. As you can see, I took two sells, then I took off one contract each here. So now the time is 11. I took out this because it was already 11 a.m. New York time. So remember, as I told you, my model is perfect for from 7 to 11 and 1 a.m. to 5 a.m. So this is basically it. So I've showed you how to trade this using on your stocks. I showed you how to trade this using forex. Now I'm showing you how to trade this using crypto. So you can literally make money out of the same model that repeats every single day. So this is the last video. This is the last chapter. So hit the subscribe button. I hope I've shown you enough to make you see how this thing repeats every time I show you the repetition of price. We have a competition where one can win a free 6 weeks mentorship. So what you have to do is just to subscribe, hit the like button, share, and comment. Leave a comment in every thing that you want us to elaborate on our trades. If maybe there's something that you didn't understand, you can just leave a comment. Then on my next video, I'll try to reply on the comment that you left. So yeah, so if you can just see from here, from this high here, I'm just trying to show you from this high here to this low here. Like that's a lot of pips that are coming from that high to this low. So having this in your everyday trading is going to be perfect for you. So that's all you need, guys. Remember, the first thing you need to do is to figure out the 630 or the 0030 opening range and measure to the second standard deviation, which is here. Measure to the second standard deviation, which was here. The price get to it, created relative highs and relative lows, and then the price traded higher, took out the buy side first. Then now we're targeting the sell side as the drawn liquidity after we've measured the deviations. So I hope you find this one insightful, and I hope you did enjoy our 5 days pattern recognition. Um, See you again in our next video. Just hit the subscribe button and share. Thank you, guys. Bye.